Very well. Again, welcome to everybody. What we're going to do today, can you all see the screen? Cotswell and Johnny, just nod your heads if you can see the screen I'm sharing. Cotswell, can you see it as well? Great. Now, what we're going to do is I took a few articles. I normally, what I try and do is I try and keep up to date in the press with the various articles and what they write about the current situation. Now, you can always go and have a look at Fin24 and Business24. Now, I took one of the three articles that we're briefly going to refer to today. And this was an article where Lemise or Maji wrote about the what is called the irrecoverable financial costs. And this article appeared on the 15th of April. Now, what is interesting is that they have a rather pessimistic view subsequent to an interview with the South African Chamber of Commerce and Industry, or SACI. Now, what I thought we should do is first have a look at the bad news. Now, the Chamber of Commerce is of the opinion that the lockdown will lead to irrecoverable financial losses for South African businesses and compromise trading conditions for the remainder of 2020. Now, to a large extent, I actually agree with this pessimistic view, but you will hear and see that it's not all doom and gloom. And as a matter of fact, this was a report which was basically a day after the South African Reserve Bank cut the repo rate for a second time in more or less 4 weeks. And over the past 4 to 5 weeks, we actually saw that the Reserve Bank cut the repo rate with up until now 2 percentage points. And the repo rate is at the moment sitting at 4.75%. Now, it means in practical terms for us as property investors that the prime rate which the banks would charge on finance products, like, for example, bonds, would now be sitting at 7.75%, if my calculations are correct. So now, of course, this means that the outlook for primary residence buyers, if you have a look at the notes there, my comment subsequent to the release of this, these results by the Chamber of Commerce and then this article, is that it means for the rest of 2020 that the outlook from a financial perspective for primary residence buyers is not bright. As a matter of fact, we've already seen quite a dramatic decline in the purchase of properties, and the bulk of that decline, we have to understand, is the very negative outlook for those people who now purchase properties because they want to live in it. So primarily here, we're talking about people who want to buy properties where they will go, which they will occupy themselves. Now, of course, as you will see a little bit later, most people already understand what the experts predict and preach, being that there's a financial meltdown. And that businesses will fail and close, and the people who are employed by those businesses will, as a result of that, will lose their jobs. Now, if you're unemployed, of course, you're not going to buy a new house. Now, of course, it appears to be a dark prediction. But what we have to understand, and which I want you to realize at this point in time, is that every person who buys his own home or her own home is a tenant lost to us. Now, if you think about it for a moment, it makes sense. Because our tenants are people who do not own their own homes, and that's why they're renting from us. So if the market reacts to the extent that people don't buy their own homes, then it means those people have to rent properties, and lo and behold, they rent it from us. So that's why I warn repeatedly that if the economy is in decline and people don't buy properties, it is actually an opportune time for property investors, because the takers, the market segment of our clients being the prospective tenants, is getting bigger. Now, the second point of this note, of course, is the fact that we will see the so-called ALA transactions increase in scope and numbers. Now, for those of you who don't yet know what an ALA transaction is, I'm going to summarize it in one paragraph, and I will also, during the course of next week, try and do a separate seminar of about an hour to discuss the ALA separately. But let's just summarize what an ALA transaction is. Godswill owns a property, which is a flat somewhere in Tshwane. For whatever reason, Godswill is not interested in this particular property anymore. Very often, it is because people immigrate, or you want to sell the property because you're going to retire and you want extra capital, or you want to sell the property to purchase in its place another 2 or another 3 with the proceeds from that property, or it is simply a property that does not fall within the scope of what you want your portfolio of properties to consist of. So many reasons. Of course, there's also the really important reason and consideration being that the owner who lives in the property at the moment lost his job or her job, or due to the economic crisis cannot afford this property anymore and now needs to offload it. Now, you will agree with me that even though it's really sad, and even though the country and the world for that matter is suffering, and the whole economic environment is in panic mode, we shouldn't lose sight of the reality that there will be an incredible opportunity to purchase properties on ALA. Now, if we can, if I can stop myself from being sidetracked, so if we return to the example, so Godswill now wants to sell this property. He bought this property about a year ago with 100% bond at prime rate, which is now sitting at 7.75%. And he bought the property, for argument's sake, at the price of 500,000 Rand. Now what happens is, because he bought this property with 100% bond, or even 108% bond, which the banks have been doing, he cannot ask an estate agent to sell it, pay the estate agent the commission, and still being able to pay the outstanding balance on the bond. Because during this economic climate, the property is still valued at 500,000. He still owes the bank very close to that, simply because he's only been paying interest, mostly interest. It has the result that he cannot offload this property in the normal course of events or via a normal standard transaction. So what happens is, he approaches Gert and he says to Gert, listen, why don't you buy this property from me on installments? So literally what I would be able to do, when Godswill started out with this property, his interest rate was 10%, so his installment was around about 5,000. And if you just use that as an example, then what would actually happen is that you have a situation where I would probably enter into an agreement with him to say, I will purchase this property from you for 500,000 Rand. I will pay you prime rate, which is the rate that you are paying your bank at the moment. And over the next 19 years, I would then pay you the monthly installment on 500,000 at prime rate over a period of 19 years. So what would then happen over the next 19 years, I would pay this installment into the bond account of Godswill over this particular property. And I would, from the date that we agreed upon, actually have occupation and use of this property. So what I would do is I would put a tenant in there, or I would get, if Godswill is living in it, I would rent the property to Godswill, and I would treat this property like I would treat any other investment property. Income and expenditure, and they have to make sense. Now, the implication of this is, according to the Alienation of Land Act, number 68 of 1981, is that I will have the occupation and use and enjoyment of this property. The terms or the existence of this contract will be recorded against the original title deed in the deeds office, but I will only take ownership finally of this property eventually when I have paid Godswill the full capital and interest that I owe him. Okay, that's the ALA transaction. As I said, we would probably sometime next week have a more detailed look at the ALA itself and how do we go about to get these properties, because there's the catch. Now, I'm a firm believer that for the rest of the year, the ALA transactions is going to be a significant part of the expansion of our portfolios. Now, the IMF, the International Monetary Fund, on the 13th, that was Tuesday, the 13th of April, actually called this pandemic the worst economic downturn since the Great Depression of 1929. And you will see what is interesting, the IMF is actually quite positive about the potential contraction of the South African economy, and they expect during the course of 2020 this contraction to be 5.8%. In other words, our economy would not grow, it would not become bigger, it would become smaller with 5.8%. Now, this is a massive contraction in normal terms. Just to give you an indication, China started reporting their economic figures during approximately, I seem to remember, 1992, during that period, 1992 to 1994. Now, since then, since they started reporting their financial data, they have never had, ever, a contraction of the economy. Now this year, for the first time since they started reporting their economic data, they now have already at this point in time a contraction of their economy to the tune of approximately 6.2%. You can see the impact of this, the coronavirus or COVID-19, the pandemic, is significant and dramatic. Now, keep in the back of your head the prediction of the IMF of contraction of the South African economy of 5.8. And you will now remember that I said it is actually very conservative, because many of the prominent economists and I believe that it's going to be much more. Now, what is also interesting, if you look at what the South African Chamber of Commerce, subsequent to the publication of the IMF, said, is that Richard Downing, one of the senior economists from SACI, said that the cash flow problems are expected to continue throughout the remainder of the year, and the coronavirus is expected to disrupt supply chains. In particular, respondents to the survey also said that they expect, and here's the catch, expect loss of businesses and consequently job losses if the lockdown restrictions are not adjusted. So what we know now is that the lockdown restrictions were not adjusted. As a matter of fact, they were made rather more strict. Now, what is the reality for us, except for the fact that, of course, it was extended with another 2 weeks? If we look at what we knew before all of this exploded in our faces, God's will, Johnny, Sean, all you who have been religiously attending seminars and workshops, you will remember that Bianca and I started warning about 4 years ago that you have to take certain steps to protect yourself and your property portfolio against bad times. Now, lo and behold, the bad times are upon us. And one of the things that we warned about is to say, you have to find ways and means. Sean, you will remember, you and I have spoken about it repeatedly, is you have to find ways and means to shield yourself and your portfolio against threats and economic impacts by, in the first instance, try and make extra capital payments into your bond accounts. Now, of course, before you do that, you have to have what Standard Bank calls an access bond, and ABSA calls it a flexi bond, and all the major banks actually have this facility. It simply means if I'm supposed to owe the bank at this point in time 500,000, and if I pay an additional 50,000 into that bond and reduce my outstanding balance to 450, I have access to that 50,000 again, which I have paid in addition to what I was supposed to pay. That's a so-called flexi or an access bond. So from here on in, I'll just refer to it as an access bond. For those of you who don't understand it quite yet, please send me a mail, and I'll make sure that you get all the necessary information about it. Now, what we've said all along is pay every extra penny that you have into that access bond, because there will be times that you would potentially want access to the money that you've saved in your access facility. The second thing that we warned about, and you will remember this was in November 2016 during a workshop. It was actually the annual workshop. We stress the importance of so-called vacancy provision. Now, we're going to do the numbers today, and I'll show you what the impact of it would be. And it is that if you own one property, try and take between 5 and 10%. Normally, if you can afford it, make it 10% of your rental income, and pay that into your access bond. Or if you don't have an access bond, open a savings account and pay that 10% every month religiously into that savings facility, whether it be your access bond or whether it be a savings account. We always advise that you use an access facility because you would save interest on your bond account. Let me give you an example. If you have a bond of 500,000 and you pay 10% on that bond, then it means you will pay for a year 50,000 in interest to the bank on that bond. Now, if you have an extra 100,000 and you pay that into a savings account where you would earn 3% interest, for example, except for the fact that you will pay potentially income tax on that rent, or on that interest income that you receive from the bank, you would receive from the bank 3% on 100,000, which of course would be 3,000 for the year. Now, the principle is this: if you calculate the 10% that you would save on the 100,000 on your bond, it would mean if you pay the 100,000 into your bond, you would save 10,000 Rand for the year, because it would reduce your capital with 100,000, and you would literally save 10,000 in interest that you have to pay the bank. Alternatively, put it in your savings account and earn 3,000 Rand for the year on that particular investment. So it's a no-brainer, because you have to choose between saving 10,000 Rand and it has no tax implication for you, or earn 3,000 Rand and potentially you will be taxed on that 3,000 Rand income. I hope it made sense. So, back to vacancy provision. Take that 10% of your rental income and put it into your access bond. Because not only would you save interest, but you would build up a little nest egg for when coronavirus hits. Now, if you haven't done any of those, we will have a look a little bit later at what now. What do we as investors do? One of the things that we now need to understand, third thing that we started preaching during that November 2016 workshop, was we have to screen our tenants, our prospective tenants, more closely. We have to also now rethink our methodology. And we have to add to our screening process when we are screening prospective tenants the employment status of this prospective tenant, in the sense that we will have to be careful to rent our properties only to so-called blue chip employees or employees of blue chip employers. Now, there's a difference between a blue chip company, as you would get it on the JSE, the stock exchange, and a blue chip employer. Let me give you an example. These large mining houses are certainly blue chip companies because they're massive companies with valuable shares which are traded on the stock exchange. But from our perspective, they're not blue chip employers, because the mining houses are exceptionally subject to the economic whims. If things are bad and the gold prices are down, or the diamond prices or whatever commodity they're mining are down and they have to close mines, then they would reduce employees, cut staff, and they wouldn't fill available positions, which means it's a blue chip company, but your employer is not, from our perspective, a blue chip employer. Whereas if you're employed by, for example, national government or SARS or any one of these, then certainly it is a blue chip employer, because chances are that the mining company for which you work would retrench you by the drop of a hat. Whereas if you're employed by the national government, it is far more unlikely that you would be retrenched or that numbers would be reduced. So those are the realities. And from here on in, we have to understand that this is a valuable lesson for all of us, that we have to add this particular issue to our screening process of prospective tenants. Now, just for interest's sake, we have already, by the end of March, seen an 18% decline in the sale of new motor vehicles. Now, let me just tell you how significant and how humongous this actually is. We only had 7 days of lockdown during March. So during the period 23rd of March until the end of March, Sales of new motor vehicles declined with 18%. This is massive. So these are the realities. And you can see that the trade activity index during March alone declined by 3 points. Now, that 37% of the index is already extremely low because whenever it is below 50%, it is already on the negative side. So the reality was this. Initially, the lockdown was going to be 21 days. By now, we obviously know it was extended with another 2 weeks. And have a look at this. Based at that point in time, when it was still going to be 3 weeks, the Reserve Bank projected 370,000 job losses. And here's the bad one. More than 1,600 businesses to close down. Now, this was before the lockdown was extended with another 2 weeks. The truth is, in my opinion, with all due respect, you can more than double both these sets of numbers. There we go. The moment that a business closed down, of course, it's not only the business that's going under, it is also the employees of that particular business who will be immediately in a position where they suffer hardship. And where they are not in a position where they would be consumers in the normal sense of the word. The moment that those businesses close down and these people lose their jobs, immediately they will not be able to pay their rent. Now you can understand, if we can come back to enhanced screening, sad as it is, the tenants whom we put in our rental properties need to be tenants who are employed by blue chip employers. Now, the Reserve Bank governor said the following: both the supply and demand effects of this extension reduce growth and deepen it in the short term as businesses stay shut for longer and households with income spend less. This will likely also increase job losses with further consequences for aggregate demand. The impact will be particularly severe for small businesses and individuals with earnings in the informal sector. Now, subsequent to that, FNB had an analysis of the history of market events. And they went back for basically 100 years. And FNB, First National Bank, said the following: South Africa's JSE All Share Index has plummeted on the back of COVID-19 virus announcement and the steps taken by the government to reduce the spread globally. Other central banks, including the US, have implemented emergency rate cuts and other measures in an attempt to reduce the impact on the markets. But this has done little to correct the financial market decline. And there's the reality. No matter or notwithstanding that 2% reduction in prime rate, it has had almost zero effect on the financial health of the average man. What it did, however, do, it has literally caused chaos on all the share indexes throughout the world. And they pointed out correctly that it is not the first time in the history that a dramatic event would have a dramatic impact on the share index. Now, have a look at, I hope you can see this clearly. Have a look at the JSE All Share Index. which they provided. Now, if you look at this, unfortunately, you cannot see this clearly, but this was in the 80s where it started here. And then during more or less 2008, you remember that, Black Monday, this graph was the growth of the index. Now, the index, very briefly, is the following. You take a certain number of shares in a bouquet. If you take, for example, the top 100 of the shares traded on the exchange, and you add all of their values and you divide it by 100, you will get an average index. In other words, those top 100 companies, what is the average value of those shares, and then you get an index. Now, in 2008 with Black Monday, do you remember that? 2008 was the direct reason or cause of the Consumer Protection Act, for example, and the National Credit Act, etc., etc. There you can see it's actually a reasonably small dip that it took. And then it grew back, and it reached in 2010 approximately the same level that it was just before Black Monday. And then it started going up. And then we had the Asian crisis there, and you can see a smallish dip, and it rebounded quite dramatically. And then, of course, it fell flat on its face again. But it grew back, and here approximately at this point in time, we actually saw that it reached the same level. And then we had the tech bubble burst there in 2003. Sorry. Then it dropped again. But what you can see is gradually over the years, the curve is upwards. Now, from the tech bubble burst, it actually shot up, actually dramatically. Until we reached that financial crisis there's actually 2008, sorry. And then what happened is you had that massive drop. Look at that. That was the 2008. Sorry, Black Monday was quite a while back. Now, what happened is that it fell completely to a share index of there. And then it also climbed again after that. It recovered dramatically and had ups and downs and ups and downs. And look at what happened with the coronavirus. You can see, if you look at the gradient there, the curve, it was more gradual. This was literally overnight. Look at that. It's almost a straight line down. And there we're sitting there. So what would I not do at this point in time is, first, if I am in shares at this point in time, I wouldn't sell them for the simple reason you would be selling at that level, whereas you bought perhaps there. So if I have them now, I would hang on to them, because what comes down must go up again. And this is what it tells us, isn't it? So yes, the bottom dropped out of it, and we're now sitting there, and I've made this dramatic capital loss from there to here. But I would just keep my cool and hold on to it, because what happened here will happen again after this. So that's as far as your shares are concerned. Don't panic, sell it, keep it, because it will grow. Or it will eventually over time grow back again. It's going to take a number of years, and we're not sure yet how long it's going to take the world to actually develop an antidote or a proper treatment for this virus. Okay. Subsequent to that, Sibongile Khumalo wrote another article. And again, it's all bad news, or apparently it's all bad news. But the heading of it on the 15th Remember, this was after the second rate cut, shortly after it. The heading of this is further interest rate cut on the horizon as coronavirus pummels SA economy. Now, first, she starts out to say this impact is worse than the one that we saw in 2008. Is it true? Actually, we don't know yet because we haven't hit bottom yet. But at this point in time, it would appear that it's going to be actually far worse than the 2008 financial crisis. Now, this is according to BNP Paribas. Now, these people predicted that the recent measures aimed at cushioning the weak economy against the virus, including the Reserve Bank's rate cut, is probably going to be inadequate. And they also say that this is the first rate cut at consecutive monetary policy committee meetings. Now, we haven't seen this for as long as I can remember. In the history of South Africa, now remember, South Africa was cushioned or screened against the 1929 depression because we simply didn't have the advanced economy that the United States had, and we didn't have the same risks. So what was an immense, dramatic period in the economy of the United States during that period, 29 to approximately 1932, was nowhere near as dramatic in South Africa. But the reality is this, that since the Second World War, we probably have only during 1984 approximately, and perhaps 1992 around about there, where we had this reaction from the Reserve Bank to actually dramatically in short sequence cut interest rates to the extent that they did here. So this is uncharted waters. It's new territory, and there's no doubt about it that it's sort of unheard of. And the average interest rate, or shall I call it the prime rate, since 1920 approximately, 1930 approximately, somebody told me the average interest rate since then until now was approximately 10.25%. That was the average over this, let's just call it almost 100 years. So if we're sitting on 7.75% at the moment, you can see it is well under the average prime lending rate during the past 100 years. So it is significant. Now, what is interesting, have a look at this. Okay, as I said, all of this from here all the way up, that's bad news. But have a look at this. There's a prediction. They say they have already penciled in and predicted an additional rate cut this year, over and above what we've seen, of at least 125 basis points. That means 1.25%. And they also carry on to urge the policymakers to come up with more dramatic interventions. Now, why is this so important? Because if we translate this in financial terms, then it means what they and other leading economists are concerning or predicting is that they see this prime rate of 7.75% during the course of the rest of the year drop with another 1.25%. In other words, drop from 7.75% to approximately 6.5%. Remember that number, 6.5%. We're gonna come back to that. Great. So there's a little bit of good news. Now, if we have a look at a little bit further to that, subsequent to that, is you remember the Reserve Bank said, or the IMF said, they predict a contraction of our economy, the GDP, the gross domestic product, of 5.8%. BNP Paribas are probably closer to the truth, because they're predicting, if you have a look at this, 8.5%. And they revised that from what they previously predicted to be a contraction of 4%. Now, what does it mean in monetary terms? Let's say, for argument's sake, that the gross domestic product of this country for a year is 100 trillion rand. Then, if it doesn't grow and it contracts, then it means that 100 trillion will reduce with 8.5%, which means 8.5 trillion that it will become smaller with. Now, if you look at that number, that is massive. I personally think BNP is still somewhat conservative. And I can tell you now, I suspect the contraction of our economy is probably going to be in excess of 10% for the rest of the year. Now, let me just tell you how significant this is. We have another 8 months left in the year. So if we say the economy is going to grow smaller with 8.5% for the remainder of the year, then it means the economy will contract with 1% per month. Now, if that's not earth-shattering numbers, then I don't know what is. But okay, so it is significant, and there's, of course, this method in my madness why I'm giving you all these apparently boring numbers. They're not boring. They're actually important, because it gives us an indication of what we can expect for the rest of the year. Again, all of this is bad news all the way up. Now have a look at this. Growth is predicted for next year by BNP. And BNP actually says, if we get through this year, our economy should grow with 2.3% during the course of 2021. Prior to this lockdown, they predicted a growth for next year of approximately 2%. The Reserve Bank, they more or less have the same prediction, and they say next year our economy would grow with about 2.2%. And what's interesting is they predict the growth of our economy during 2022 of 2.7%. Now, what I want you to understand here is, if we see a drop in 10%, a contraction of 10% this year, then it means by the end of 2022, we would not have yet made up lost ground, because the 10% that we're going to lose this year minus 2.2 would give you 7.8, minus the year after that 2.7 would give us 5.1% that we still will be behind with by the end of 2022. Now, just just to give you an idea what the recovery curve will be. What we're going to lose this year, we will still be short with to the tune of 5.1% by the end of 2022. So we would not have made up what we lost yet by the end of 2022. Okay. Now, what is interesting about this and what is important is that we can expect some growth next year and some more growth in 2022. Now, Davy Ruet is the chief economist of the Efficient Group, and he had something interesting to say. Job losses as a result of the lockdown will worsen the country's already record unemployment rate, currently at 29%. Davy Ruet, chief economist of the Efficient Group, describes this as one of the biggest socio-economic challenges facing the economy. Now, again, that 29% that you see there is the 29% that we know of. In other words, this is a statistic that was derived from the number of people who are still looking to find jobs. They're applying for jobs. The people who stopped applying for jobs and who are simply not interested, or those who are not interested in actually getting jobs, or who have given up, those numbers are not included in the 29%. So I'm telling you that this 29% unemployment rate is far higher than what we actually know. Now, just for interest's sake, it is on record that young people between the ages of 18 and 35, in excess of 50% of them are currently unemployed. They don't have jobs. So just to put that 29% in perspective. Now, these are the realities from our perspective. The IMF called this an unprecedented threat to development in Africa. They're absolutely right. The region's economy, now that's the whole region, set to shrink by 1.6% in 2020. That's for the whole region. I think they're extremely conservative, and I think that's going to be far higher. And except for the fall in per capita income, the unemployment rate is going to be unmanageable. So yeah, we certainly have a problem, and you would have heard that the World Health Organization are clamoring for over $140 billion, which need to be spent just on dealing with the coronavirus in Africa alone. Very well. Now, I just want to tell you that we eventually, Bianca and I, we were going to send out this newsletter, and then it was decided to extend the period with another 2 weeks, and we decided, well, okay, we would rather do these seminars. But if you look at what happens is practically the following. What we're doing here is to say, okay, all businesses in South Africa, except for the so-called essential service providers, will be closed during the lockdown. And we've actually seen that it is enforced strictly. Now, it means these businesses will not trade, and as a matter of fact, you're not even allowed to allow your employee to work from home. That's how strict it is. Now, we have seen that the prediction is that thousands of businesses will, as a result of this, close down. But what we also had, by the end of March, we already had a number of employees who only received a percentage of their salaries. On average, apparently, it would appear those who received reduced salaries was approximately on average 50% of their salaries. And then after that, at the end of April, either a large percentage of employees will not receive any salary whatsoever because their employer wasn't able to earn income. Alternatively, we were told yesterday that a large percentage of medium-sized businesses and the smaller businesses notified the employees that they will receive 30%. Now, what is the reality of that? Your tenant is going to be sequestered at home, and he will only receive a portion or perhaps 50 or 30% of his income. But how does he pay his rent? From the money that he gets from his employer. So the question was, what do you as landlord do? And the response is nothing. You don't do anything at this point in time. The important thing is this: there is a misconception that people apparently have the idea that if you don't get a salary, you don't have to pay your rent. Nonsense. It's absolute rubbish. It's not the truth. Where many people actually get this idea from is that there's a lot being said about if you're a small business or a medium-sized business or even a large business for that matter, and you rent the premises where which you occupy for business purposes, then you do not have to pay your rent, or you can get away with not paying your rent because of what is called vis maior. Vis maior is just the Latin for what is colloquially called an act of God. In other words, it's war, a world war, or famine, or floods, or hurricanes, or whatever. So in other words, it is an event which is not man-made and beyond the purview and powers of men. So this is vis maior. Now, the argument, and I actually agree with him as far as this is concerned, that if you're a business and you're renting your business premises from a landlord, these massive landlords, and by law you're prohibited from going to work. Let's say you have a factory which manufactures furniture. You're not allowed to go there. If you do, they will arrest you, lock you up. So now it means you cannot go to work, you cannot go to your factory because of vis maior. You cannot trade and manufacture furniture and get your employees to go there, etc., because of vis maior. What it also means, and they're quite correct when they say, it means that you as the tenant, the commercial or industrial tenant, or a tenant of a commercial or industrial property, you do not have vacant, undisturbed possession of that business premises. Even though the landlord is prepared to give you possession and occupation, he cannot give it to you because of vis maior, which means you cannot pay him because you do not have occupation. Now, that's the argument. Now, as far as agricultural, perhaps, definitely commercial, and definitely industrial buildings are concerned, I agree. That's a watertight argument. However, you cannot apply that principle to residential property. Why? It's as simple as this. The tenant is, in fact, in undisturbed occupation of that property 24 hours a day, 7 days a week, as a matter of fact, for 5 weeks, never-ending weeks. So you can see what the difference is. This mile, as far as residential rentals are concerned, simply does not apply because your tenant has a valid and binding lease agreement. He is in occupation and possession of the property. And the truth is, no matter how sad or unhappy it is, he remains liable. He has to pay the rent. But the law and practicalities are very often not the same thing. The reality is this tenant didn't receive salary at the end of March, or he received only a portion of it. And he will probably not receive salary at the end of April, or just a portion of it. So he will simply not have the money to pay me my rent. It is as simple as that. No matter what the law says. So I say again, up until this moment, if you have not heard from your tenant or your rental agent, you just don't do anything, because what must you do? Now, let's say for argument's sake, you are now approached by either your tenant directly, alternatively by your rental agent, who says, the tenant cannot pay rent at the end of April. This is the first time where you actually do something. Now, what we have done is we said, okay, it is as simple as this. If the tenant is not going to be able to pay your rent and he has the common decency to notify you, then what you do is this. Either to the rental agent or with the tenant directly, we, from our perspective or from our side, would provide you with an acknowledgement of debt and an undertaking to pay, which is provided to the tenant, and it simply says the following. Let's say, for argument's sake, the rent is 6,000 and he can only pay 3,000 of the rent by the end of the month. Then this acknowledgement of debt and undertaking to pay will say the following. I, so-and-so tenant of so-and-so property, hereby acknowledge that I am indebted to Mr. Landlord in the sum of 3,000 Rand, and I undertake to repay this debt in 3 or 6 or 9 monthly installments, whatever you find is fair and applicable, plus interest thereon at, for example, 7.75% if that is your bond rate. And then the tenant will sign this undertaking that he says, as from the end of May or June or whatever is applicable, I will start paying, except for my normal rent, the arrears plus interest in 3 or 6 or 9 or whatever number of installments. And there you have it. Now, how do you as the landlord survive this? Now, hopefully, you listened to Uncle Gert way back in not that far back, but 2016, and you started putting money into your access bond. And in addition to that, you provided for vacancy by paying that 5 or 10% of your rental income into your access bond. And you can now ride the storm for the next 2 or 3 months because you have money available. You have access in your bond. Now, let's hope you did that. Let's say, for argument's sake, you did not do that. And it's quite possible because, just for interest's sake, if you have a situation where you faced with a tenant who's not going to be able to pay, there are the two email addresses. You can contact us for help. You can either send it to info@p3invest.co.za or to info@gcsattorneys.co.za. We would gladly help you. Now, so let's say you don't have anything saved in your access bond and you didn't provide for vacancies. The last recourse for you is that you approach your bank now. Many of you would have already been approached by your banks, and your bank would have offered you payment holidays on your bond installments. If they haven't, then to survive your tenant not paying end of April, perhaps end of May as well, you then ask your bank to grant you a moratorium or a payment holiday for a period of 3 months on your bond. Now, this is a simple, straightforward process, and I promise you the banks are more than accommodating. The catch is this: if your bond was already in arrears when we went into lockdown, it is highly unlikely that the bank is going to be prepared to give you a payment holiday from here on in. So if that's the situation, then you have to knock on our door and see if there's something else that we can do. But there's the reality. This is what is the solution as far as we are concerned with the challenge of tenants not being able to pay rent as a result of the pandemic and the lockdown. There you have it. Now, you know, we have a long-standing relationship with Green Door. The interesting thing is the banks are actually still working. And our good friends, Gerrit and Marita at Green Door, they have been processing applications, they and their staff, they're working remotely. And we've already had quite a number of approvals in principle during lockdown. So what they've now developed is a pre-qualification and free credit check, which is online. Everyone who wants access to this, just please send me a mail after the seminar to gert@p3invest. Let me repeat that, gert@p3invest.co.za. And I'll forward this document to you, because from this document you can actually click on it and it'll take you directly into their system where you can do an online application. Now, why am I saying that the banks are more than happy at this point in time to entertain your applications for finance? There's a number of reasons. I'm going to summarize it quickly. The first thing is the interest rate is almost at a record low, which means that what you could qualify for 6 weeks ago is far less than what you can qualify for now. It's as simple as this. Let's do the number. If I had to pay, for argument's sake, on 100,000, 9.75%, 5 or 6 weeks ago, as would have been the situation, then what would happen is my interest for the year would have been on that 100,000 Rand, 9,750. Now, to be able to qualify for that, my income would have to be 3 times that. So just to make it easy, I would have had to earn 30,000 Rand to afford that installment. However, if it now comes down to 7.75%, then it means if you do that calculation, then it gives you 22.75, 23 approximately thousand Rand that you have to earn per month to qualify for that same 100,000, simply because of the drop in interest rate. So it is actually easy to do that calculation. Now, so during this time, we find that ABSA especially, they offering further advances on bonds. They offering second bonds. They're offering cancellation of existing bonds, or so-called switch bonds, and they're offering further finance on existing properties, and also finance on properties where the bonds currently have been paid off. So the banks are actually pretty active, and they're happy to do business, and for them it is actually business as usual, and they're rearing to go. So any one of you who are looking at this, it is business as usual for the banks, and you can certainly make use of that. Great. Now the document that I've shared on screen now is one of the things that I'm suggesting all of us do during the next 9 days of lockdown, including those of you who are unfortunate enough to render an essential service and who's actually out and about at the moment. My sympathy with those of you who's in that particular situation, and please stay healthy and be safe. Now, what this is, and I know people like Sean, I still owe you this document. I'll be sending it off later this afternoon to you, and I'm going to ask all of you who already own properties, a property or properties, that we go through this exercise. This is part of the mentorship program. What we've developed here is that you literally use this document. You'll see it's a straightforward Excel spreadsheet. What I'm asking you to do, if you're interested in this, is that you insert there the property's name. Let's say, for argument's sake, it is number 23 Northview Heights. Then you simply insert it there, and additional repayments, we can deal with that. If you make additional repayments of 500 Rand a month, then you insert it there, etc., etc., and then you complete all the information. Let me just see. There's somebody who's asking for my attention. Okay, so now what you literally do is you insert all that information. Okay, Angela, I certainly will. I've got that. Thank you. I'm going to ask you I'm quickly going to give you my email address. I just sent it to you now. Please, just if you don't mind, Angela, just send me a very brief mail that I can have that information. And then simply complete this information. You'll see it's actually easy. That is a current bond. In other words, how much do you owe the bank at this point in time? If you know how much was the bond registered for, if you don't have that information, don't worry about it too much. We can actually get it from our side. The same with a bond, the remaining term, you can find that easily in most instances on your bank, the bond statement. And then, of course, the interest rate as it is at the moment. Now, be careful with this because it may be so that the prime rate at the moment is 7.75%, but many of us still have rates which are prime less something. So if, for example, your rate is prime less 1, then it means your current interest rate would be 7.75 minus 1%. So, oops, yeah, that needs to have a percentage sign. Minus 1%. There we go. Then it means your current interest rate, which is applicable on this particular bond, is then 6.75%. So just make sure that you don't give me the incorrect information. And then this, of course, is how much that you pay for this property when you bought it originally. And if you have the municipal valuation, please add it there. It is sort of important to calculate the capital growth of the property since you bought it originally. Now, what happens is that many of you actually don't know what the municipal value is. In most instances, you can find this municipal value on your water and lights account, your municipal invoice. And then, of course, the rent that you get per month, your current installment, how much is the levy, the municipal account, how much is that? And if you have a rental agent, let me just add it there because it's sometimes confusing. Rental agent's commission, that rental agent charges you something, and it varies between 8% and as high as 15%, I heard the other day. And then others is, for example, a special levy, or an arrears on levies or municipal rates and taxes that you're paying off. So let's say you had a tenant in there who never paid, if it's a conventional property, never paid the municipal charges, and you didn't pick up on it in time and left you with that account of 18,000 Rand, and now you've made an arrangement with the municipality to pay it off in 18 equal installments. Then you would add that as 1,000 Rand per month, and you would actually change that to pay off municipality or whatever may be then the case. Okay. So, if you once off made a 80,000 Rand capital reduction, you please insert it there. And if you actually had to pay for the registration of your bond or even bond and transfer fees, and if you can still find it, just insert it there, please. Then now this is available, and anyone who would like to participate in this, this is actually a very nice exercise. At this point in time, our system provides for 40 properties. So up to 40 properties in your portfolio. I know there's one or two of you who's actually beyond that. If you have that situation, just contact me and I'll explain to you how to make provision for the properties more, over and above 40. Now, you only capture in the white areas, not in the blue or the dark blue, except for this one, of course, you might. And then if you know what your individual tax rate is, just insert it there. Okay. So this is a document which is available, and you're more than welcome to participate in this process. Good. So as I said, let's apply all this information. And I know it's probably a lot, but I decided to use Snowden, which many of you would know is it's a current project with our primary developer partner at the moment. Unfortunately, there's only, I think, 41 of them left, if I'm not mistaken. But let's have a look at the numbers. This particular one that I chose is a 2-bed, 1 bath, and they vary in size. There's a slight difference between 59 and 63 square meters. This is basically an analysis of the property itself. Now, this is one of those unique developments where we have been able to negotiate an exceptional bulk P3 deal. The first thing is that for the first 2 years after date of purchase and registration, the developer will actually guarantee the rental, which means whether the tenant pays or not, we are guaranteed that we will receive the rental even if the developer has to pay it from his pocket. So in this particular instance, if during month 7 the tenant does not pay, then the developer will pay me 7,586 in lieu of the tenant who didn't pay, and he will recover it from the tenant. And how we've structured that is that it is a requirement of that agreement that the developer or seller will be managing the property. He will be our rental agent for the 2 years. So if the tenant doesn't pay, he's gonna pay us. Now, the other interesting thing is that as from month 13, in other words, the second year, the developer guarantees a 6% increase in rental. Now, you can see there's the income growth. Now, if there's my income for year 1, so it means, if I can just quickly do that, equals during year 2, I am then guaranteed, as from month 13 until month 24, I'm guaranteed by the developer a rental income of 8,041 on this particular property. So this is actually unique. And then the third thing that we were able, you can see where the levies are, the developer is giving us a cashback of the levies for the first year. So upon registration, he is going to pay me that times. So upon registration, he's going to pay me 9,072, and I will put that into my access bond, and every month from my access bond pay the levy. This is why you will see during year one there is no levy. So those are the three things. Now, what is interesting with the interest rate, I want to show you something here. If I don't pay any deposit, there's my purchase price, 883,300. And if I pay zero deposit, then literally what happens is in month one, I will have a shortfall of 499 Rand per month. And this is at the rate of 7.75%. Now, if you have a look, just have a look at that. That's about 500 Rand shortfall that we have. Now, if I change it to 5 weeks ago, then it would have been this. Look at how dramatic the difference is. 5 weeks ago, my shortfall would have been 1,600 on this very same property with zero deposit. And now as it stands, it's 500 per month approximately. It is literally, if you look at that, it is literally 1,100 Rand per month difference. And this is why I said, for the property investor, all of this is good news. And I'm not talking about people getting sick and lockdown and misery and hardship. I'm not talking about that. But what I'm saying, the consequences of lockdown and the economic crisis for us as investors, there you see it. There's the difference. So now let's say, for argument's sake, that the bond that you get at this point in time is less 0.5. Yep, sorry. I should have said less equals 7.75 less 0.5. That should work. Now, again, it doesn't work. It is because I don't have a percentage sign there. Okay, there we go. Then it means your lending rate would be 7.25 and it would come down to 203 per month, the shortfall. Okay. Now, what is interesting about this is that what I wanted to show you is if I don't pay a deposit and I pay for a property 883,000, the truth is I'm not paying 883. Have a look at this. The money that I actually put in here is the shortfall during year one. There it is. Then my shortfall goes up in year two because now I'm starting to pay levies. And then it comes down again in year three, and then it's a tiny little amount in year four. So what will come out of my pocket if I don't pay deposit is literally the total sum of 22,086 Rand. So whether you like it or not, and whether you want to admit it or not, you literally pay 22,000 Rand for a 883,000 Rand property. It is as simple as that. There is just no two ways about it. And what is significant about this is I want to show you something else. If the predictions are correct, and I have no reason to doubt that by December, this interest rate would have come down with another 1.25%. Have a look at this. Then it means prime rate at that point in time will be 6.5%. And I will actually have a monthly surplus, except in year two, I'm going to have a tiny shortfall because I will pay levy. And what is interesting, I didn't pay a deposit. Now, what is rather shocking about this is it then means that I would pay 2,423 Rand, a royal sum of 2,423 Rand for a property of 883 Rand 300. So interesting, isn't it? And it is, as a matter of fact, it is rather unique. In all the years that I'm doing this, and it's decades, I've never actually seen this before. Now, what is interesting, many of us actually prefer to pay a deposit, and if you pay a 10% deposit on this property, have a look at this. Before I do that, if I don't pay a deposit, my rate is 7.75%, then it means my return, my real rate of return during year one is 884%. Why? Because I calculate my capital growth, the return there, plus my income growth, as you see it there. You see how it goes up. I calculate my return on how much did I put into it and how much do I get out of it. What is my growth in my capital and what is my growth in my income for that particular period? And that'll give me the princely sum of 342% for the year. And you can go and do these numbers. Don't accept my word for it. Go and do it yourselves. So now, let's say for argument's sake, I do pay 10%. I want you to have a look at this. You see, during year two, what my return on investment, it comes down to 62% for the year, because I'm now putting into this property not 2,000 and something, I'm actually putting into it 90,000. So my return on investment, my capital growth and my income growth is now calculated based on how much I put into it. So it means that my return on investment over this period is far less. Year two, 62%. And if I didn't put 88,000 into it, have a look at that, then it would have been 342%. So if I put that 10% into it, then yes, quite right, my real rate of return comes down rather significantly. But what is the interesting thing? If I put a 10% deposit into it at this point in time, have a look at the equity. Now, what is my equity? And I want to show you year 5. I'm going to use year 5 there. If I decline, I reduce, what the system does, it calculates the reduction of your capital year, every year, at the end of that year. At the end of year 5, originally I borrowed 794,000 from the bank. By the end of year 5, I would owe the bank 693,346. But the value of my property has gone up to 1,182,000. So it means I have equity. My equity there is 370,000. In other words, how much is it worth minus what do I owe the bank? So I have 370,000 equity. So if I take, now I can tell you now, the banks actually, I'm just going to change that. On refinance or advance, re-advance, the banks will only give you 80% of loan to value. In other words, my value in year 5 is 1182.05, and 80% of that would be 945. And it means what the bank will give me is that 329. Because the bank will now, at the end of year 5, on condition that my credit record is intact, the bank will give me 945,000. Now, this can either be a second bond, and I'm going to explain this now. Alternatively, a complete bond switch. I'll explain that now. What happens is this. It means I will be able, at the end of year 5, to get 329,000 again from the bank. I'm going to show you now how that translates, or what it translates to. Because keep in mind, at this point in time, my rental has gone up, etc., etc. But I also want to show you something. You remember I said make an additional capital down payment. So if I say I'm going to put 10% of my installment away, okay. Yeah, it won't do that because, but okay, it is 580 Rand. Okay, so what happens is if I put away 580 Rand per month extra into my access bond, what is interesting is see how that's gone up by the end of year 5. Sorry, let's do that. Okay, let's just go one back. There we go. So there's my 80%. It was 329. And then if I put in 580, that 329 goes up to 371. Now, let's say for argument's sake, I pay an additional 1,000 Rand per month into that access bond. Have a look at that. If I don't pay anything, let's just delete that first. Then it's 329 at the end of year 5 that I can get from this property through value escalation and income escalation. 329, but now I'm putting in 1,000 extra every month. It goes up to 402 Rand. There we go. It's actually as easy as that. Now, the question that I get very often here is this. Now remember, the first question is, when do I do this? End of year 4, end of year 3, end of year 5, or whatever. This is purely an accounting exercise. You do it whenever, for example, you decide, I need, for argument's sake, 176 times 2 to purchase 2 more properties and pay 20% deposits. Now, if you do that, then you know you can sort of do it at the end of year 4. Because what you will get from your property is going to be more or less adequate to pay 20% deposits on 2 properties. So it depends on what your planning is, and you're going to see this in more detail after this example. Now, what we need to understand is, you will see I still make provision here for legal costs and fees. So let's say I bought this property correctly in my company, and I'm not going to transfer it out of my personal name to the company. It's already sitting in the company here at this point, and I'm now going to refinance it. So what now happens is, if my bond currently is, for example, with Standard Bank, and I'm now going to ABSA, because ABSA is taking into account with the investors bond the future rental income and I now want to go to ABSA and say, okay, please give me 945. Then it means I'm going to have to cancel the bond currently, which is currently with Standard Bank. And let's just say that's about 4,000 Rand, the legal costs. And I have to register a new bond. Yeah, sorry, it should have been an equals. And let's say for argument's sake, I now have to pay the conveyances another 12,000 to do that. Then my legal costs to do that exercise is going to be 16,000 Rand, and it goes in there. Now, you will see after this what the impact of it is if I'm already with ABSA and I want to stick to ABSA, then it's going to be a second bond, this amount that I'm now borrowing in addition. That will be a second bond. But if I switch it from one bank to another, then I'm going to pay those legal costs, and it'll mean canceling the bond at the existing bank and registering a completely new bond at the bank where I'm taking all of this. Okay. Okay. So here's my restructure, which is a consequence of that previous information that I inserted. Now have a look at this. If we say, for argument's sake, that 5 years ago, I bought Snowden for 883,000. It is now 5 years later, and that value is now at the end of year 5 gone up to 1182.054. There's my new value. I know by now my capital growth is 6%, and I know by now that my income growth is 6%, and we know inflation is. And you can see it's exactly 5 years later, and I still, what I now owe the bank is 543,307 because I've made additional payments. Now what I want to do is I want to actually get 80% bond on that new value. So I'm asking the bank to give me the difference. And let me just do that quickly. There we go. If you will bear with me, there it is. Now, so what I'm in effect doing is I'm asking the bank have a look at this. I now owe the bank, let's say I owe Standard Bank 543. And now I want to refinance it, and I'm going to ABSA, and they say they will give me 945,000. Remember, at this point in time, my installment is now going to be 7,763 if my interest rate is there, on a loan of 945 over 20 years. And my installment at this point in time will now be 7,763, whereas 5 years ago when I bought this property, it was 6,800. My levies have gone up. My municipal charges have gone up. My agent's commission has also gone up, of course, as my income grew. And I have already invested 236,000 in this property because I paid a deposit, do you remember? And I had a little bit of extra that I paid into it, being my additional payments. Have a look there. And the legal costs now is actually 16. There we go. And what now happens is I will my net gain is apparently 278,000 that I get from it, but it's not true because that calculation provides for capital gains tax. And if it was a trust selling it to your company, your capital gains tax would have been 107,000 if you transfer it. If you keep it in the same entity, in other words, you bought it in your company and you keep it in your company, you're just switching bond, then of course, zero capital gains tax. And then what you would get out of it after paying your legal fees would be 336 by doing this exercise. So, summarize. If I bought this Snowden 5 years ago, I would now be able to go to the bank and get 386,000 net extra to buy another 3 Snowdens with 20% deposits. And lo and behold, in month 1 to approximately 11 months for year 1, in other words, in year 6, from when I bought it, I will have a tiny little shortfall, 768. Now, what is interesting, when I take, except for the money that I've already put into it at the beginning when I bought it, if I take another 402 out of it, now I would literally have put from my side, from my pocket into it, 253,000. So still, I bought that 883,000 Rand property. I bought that for 253,000. But this property has now put me in a position where I subsequently have been able to buy another 2 or 3 properties as a result of this one that I bought 5 years ago, because I can now milk it without going back into an insane negative or shortfall territory. I hope this makes sense. So this is an example of what we actually mean when we say you have to cleverly and cautiously, with circumspection, refinance. You don't just refinance to go and buy a quad bike or a overseas holiday or a caravan or whatever may be the case. The idea is that you use what you've accumulated in your property to provide you with capital to reinvest in expanding your existing property portfolio. Okay, let me just see if somebody is asking a question. Okay, Bronwyn, you guys again, just send me a mail if you don't mind, to make sure that I don't forget it. There's the, Bronwyn, there's the email address. If you don't mind, just send me a brief mail and I'll just respond to that. Great. Now, what happens is this. You can see it's actually common sense, isn't it? It's not in any way whatsoever a rocket science. Angela, Bronwyn, sorry, yeah, from Bronwyn to, okay. Let me just, I'm just going to send this email address. Sorry, I slipped up. All of you should now be able to see that email address. There we go. Hopefully, Bronwyn, hopefully you guys can see it now. Okay. There we go. Okay, excellent. Now, I will send this to everyone who asked for it. And as I said, if you don't mind, just sending me a brief mail. And then there's a question from Eupenio. His question is, how is the developer able to guarantee a 6% rental increase in this environment? The projections are that the rental will not increase or slightly decrease in order to keep the tenant due to COVID-19. Okay, this is actually a brilliant question, because it took us a long time to develop this concept, how it will be done. What happens is the following. You must understand is that the developer is going to receive, as your rental agent, 8% of the monthly rental. Now, instead of eating or spending that money, that 8% that the developer receives for managing your property is going to go into, let's just call it a hedge fund. Now, the hedge fund is going to sit there on all 60 properties. Actually, it's 59. My apologies. Let's just use the number 60 to make it easier. So if the rental, for argument's sake, is on average 5,000 Rand a month, it's more than that, but I just want to be able to make it easier to calculate in my head. And if the managing agent or the rental agent, being the developer seller, is getting 8% of that 5,000 per month, and it's 400 per month, times 60. Pen, you still following that? And then what happens is that is, if you do that calculation, 60 times 400, that is 24,000 per month. Am I right? Good. So that 24,000 goes into the hedge fund. Now, we never ever see it that in any development, this particular development goes completely belly up, something like this with the history. Now, let me just explain to you this. This development in Florida is 2.5, 3 blocks above or away from the Flora Private Hospital. 90% of the tenants in that particular development are nurses and doctors and people rendering essential services. And they within walking distance from that hospital. It's a clinic and the private hospital. Over and above that, it is just across the road from that is a large shopping center, etc., etc. And then it's just across the road from Northcliffe, etc. So the people who live there have a track record. And the calculations as to the hedge fund that is required to provide this guarantee was based on the history, taking into account what we expect to happen later on during this year. Remember, everybody is basically in agreement that as from next year, we will see at least an economic growth in excess of 2.2% for the year. So the crunch time is this year, 8 months. So we have to hedge or provide for 8 months of unforeseen eventualities. Now, again, we applied the concept of blue chip employer in this development, and 99% of the people who live there or rent there are employed by blue chip employers. I hope that answers part of the question. That also explains why we're harping on the issue of blue chip employers when screening your prospective tenant. So if you look at these numbers, then you can see if you put away 25,000 Rand a month in provision, and you do this for a period of 10 months, then you have a fund of 250,000 Rand. And if you have a 10% vacancy or non-performance in your tenants, then it means 10% times 5,000 for that period, and it gives you, if it's 500 times 60 units per month, in other words, then it gives you 60 times 5, that'll give you 30,000 Rand for that period. Am I right? So if you do the numbers, then you can see I have provided 250,000, and the risk that I literally run is 60,000. So I as the developer, if I'm the developer, would pay with a smile that 60,000 Rand rental which haven't been paid from this hedge fund of 250. I hope this makes any sense, Eupenio. So you can see the numbers were actually crunched. It took us quite a while to do this. And then Adrienne is asking, when is the property in Florida Hills going to market? It is already, as we speak, on the market. What we would suggest anybody here who is interested in that particular property, you all now have my email address. Just send me a brief mail and say, please, I'm interested in Snowdon, and then we'll take it from there. We are all working remotely, so we're working, and we'll be able to deal with it. So you're all welcome. Just send me a mail. And then Adrienne, yes, we haven't sent the packs yet. We'll do that during the course of the afternoon, because we'll put all of it together. Just remember to send me the details or the email. And then another question from Eupenio makes sense. Next question. According to Lightstone data, house price growth was 1.2% for Gauteng in 2019. How was the projected price growth of 6% calculated? Okay. This is also a brilliant question, and I'm glad you asked it, because Lightstone takes into account all residential properties throughout Gauteng. Now, it means it includes that house in Vosloorus and in Daspoort and in Midstream and in Sandton Manor and etc., all over the place, any property. Now, to give you an idea, the properties in Midstream actually came down in value. It didn't go up, because if you pay 10 million Rand for a property, and when the economy is under pressure, like it's been for the past 2-3 years, the pinch is always first felt in the luxury property market, because it is simply a numbers game. There's just so many less people who can afford to pay 10 million Rand for a property than what there are people to pay 600,000 for it. So the number that you see there is 100%, but it is skew. And this is also why we do not invest to buy investment properties in Sandton and Bryston and Midstream and all those places, because it is not an investment. We invest in those kind of properties where it's literally a property that's wanted by the majority of the population. And you can see that's in the price range, 400, approximately 400,000 to about 1 million rand in price. Now, what is important about this is that if you do the numbers for that price range in areas where we buy, in other words, not Easterus and Daspoort and Midstream and Vosloorus, etc., then you will find that that number is completely different, that price growth. And that's actually easy. Go and look it up. You'll see it is 100% different, because the more demand, the higher the price growth. Now, not so much demand in Midstream, a lot of demand in Snowdon in Florida, because that's in the market where the most people are actually active to buy properties, and that will be completely different. The other thing that we, of course, did, Eugenio, is just to add to that, is that the history of price growth since this development was completed 3.5 years ago, it was built and occupied, was actually approaching 8%, the value growth. So what we did is we were very conservative by saying, yeah, we can say there's a 6% capital growth. So you have to compare apples with apples, and it's horses for courses. I hope that made sense. Eugenio? Happy with that? And then all those who actually want to get hold of the spreadsheet templates, yeah, happy to part with it. Again, I'm going to type to everyone here my email address. I'm going to give you another one as well. And you have both. I hope I got it right. Yeah, everyone now will have that. Please jot it down. Just send me a mail, and we'll and ask exactly what you wanted, and I'll gladly let you have that. It's gonna be either early this evening, alternatively early tomorrow morning, if you guys don't mind. Now, okay, I think what we have done here, hopefully I've demonstrated what the numbers are and what is possible. Now, I think the reality for us is that I always say the numbers speak for themselves. Then many of you have already left, and then I'm going to extend my sincere gratitude to all of you who spent in excess of 2 hours in my company. Thank you very much. As always, it was really enjoyable, and it's good to see some old friends, Johnny, Godswill, all you guys. It's really nice to see all of you again, and please, all of you, make sure that you stay healthy and stay safe.